4-step method to high performance trading is about bulletproofing your daily routines, your executions, your skill set, your mindset, and your beliefs to execute your edge trading in live time. Building your discipline and confidence in live time is how you will be able to produce those results consistently over the long term. The 7-step daily routine for high performance traders is about developing your process, your habits, your mindset, your beliefs, your skill set to master the markets. Bulletproof yourself for success and consistency over the long term. The links are in the description box below. They're both free downloads. Let's get started. G'day traders, Stacey Burke from Stacey Burke Trading. Short video going over 3 playbook trade setups from the week, one from Asia, one from London, and one from the US session, just to highlight to traders the importance of being patient and sitting on your hands, regardless of the session that you're trading, but using signal days and understanding Monday, Wednesday, Friday, the template of the week, front side, back side, and executing simple playbook rinse and repeat setups. Now, there are obviously lots of trades during the week on many different currency pairs, indexes, metals, and energies, but we're just going to walk through some simple setups. We talk about the rinse and repeat of pump and dump, dump and pump templates. Signal days help us identify instruments that are potentially going to set up in our session the next day. We build our watch list. We can have a simple basket. You can have 5 or 6 currencies. You can just have major currency pairs. You can have some of the cross rates. If you're trading Asia, obviously the Japanese yen would be on your list. Friday gave a first red day signal. First red day is a day that closes below the open and has made a peak formation at the high of the week. Now, when we come to our session on Monday, we have a first red day signal. Now, this is a 15-minute chart, but also what I want to highlight to traders is how this market has closed on Friday. We have a market that has broken down on the inside and into the close pumped up. So we have a thesis now that if we have a first red day opportunity in our session, so for example, the Japanese yen's on our watch list, I'm trading New York and Asia. Some traders are trading London only or Asia only or London and New York or whatever, but the instrument goes on your list. So if you're trading Asia, well, does the instrument set up into the Asian window? We have our pump into the close. The closing range is a pump in a first red day signal. Now we have our pump into the close. Monday's session opens on a gap down. Market pumps up and begins to break down into our session as the 8 p.m. New York time window opens. First hour pumps up and puts a peak formation high in place, and 45 minutes into the hour, we have our pin hammer in line with our first red day thesis. Now, page 29 in the playbook, we have our basic model for trade entry criteria, which confirms our thesis to remove analysis paralysis, keeping things simple. We have our entry, our stop loss, and a take profit level. I can just do a range expansion on Monday as a potential profit target, a 100% expansion of the range. Now, this just gives us a simple, easy, no stress trade setup off a signal day in our Asian window. Simple rinse and repeat. It doesn't matter what instrument this can show up on. It's a simple, basic trade setup model. We have a market that's broken down out of our consolidation after pumping up, and that breakdown is where our pump begins, our Asia timing window. Simple model, entry, stop loss, and a take profit level, or a level to trail to lock in the maximum amount on this trade. An excellent opportunity for traders that took this trade on Monday, the beginning of the new week, a first red day signal. Now, at the close of Monday, the British pound closed as a first green day, made higher highs on Monday and then dumped down, but closed higher than the open, giving us a first green day signal. Now, this is a 30-minute chart, and traders in the Asian window had an opportunity to participate in the buy low setup. Now, if we just look at Friday's closing price, where the auction process begins from in the new week, we have a beautiful pin hammer opportunity in the Asian window. Again, this is a 30-minute chart. For traders who took that opportunity in our Asian window, again, this simple model, a 1-bar stop. We have entry, a stop loss, and a take profit level. Now, for traders who were looking to hold on to this position with the thesis that this may now go on a range expansion, it's day 2 on the front side of the week. Day 2 typically expands the range. They can take a projection of that high-low made in the Asian window for a 200% expansion target of the range. Now, for traders who have come along in the London session or the Europe Open, we have the low-hanging fruit opportunity, page 96 in the playbook. Low-hanging fruit, that's the trend continuation opportunity. So as I've mentioned, you are looking for that instrument. It's on your watch list. You come to the screen in your Europe-London window, and the train's left the station in Asia. But is the trade thesis still valid for an explosive trend continuation opportunity? It's first green day signal, and we're on day 2 on the front side of the week. How did price set up into the Europe-London session? So when we come to our Europe window, we have a market that's dumped back down into the Asian session longs before coiling sideways and engulfing to continue the long trade. Again, basic model for trade entry criteria, page 29 in the playbook, aligns us back in with the existing long trade, and we see the continuation later in the gap time. The original projection of a 200% expansion of that target is intact. So a set and forget opportunity with a first green day signal. Again, just simple rinse and repeat. Day 2 typically expands the range. We had a first green day signal. The train left the station for Asia session traders, and London gets the continuation trade, the low-hanging fruit, page 96 in the playbook, continuation opportunity from the higher time frame first green day signal. And just reinforcing simplicity, there's nothing rocket science about it. Keep it as simple as possible. Keep it zero stress. And how should price behave? Well, it should begin to go into profit immediately in these situations. This is a coiled market, a larger dump, coil, and pump template from Monday, higher highs, a first green day signal at the beginning of a new week, new timing cycle for the range expansion in the Europe-London window. An excellent opportunity taken by several traders on Tuesday. Excellent work. Now we had FOMC on Wednesday, the midpoint range of the week, and on the indexes, we had markets that had dumped down and reversed after FOMC and continued to trade higher prior to the US session open. Now, what made the Dow stand out is that it actually broke the high of week level prior to the New York Open. But we had a market now that has made higher highs before dumping down into the open. We had President Trump speaking. We come to the screen, the market's already broken the high of week level. We redraw that level, and you've heard me say, when a market's dumping down before the session begins, think pump, or when markets are pumping before the session begins, think dump. Now, we had President Trump, an unscheduled speech that came onto the calendar a little bit later that said he would be speaking at 10 a.m. So as I mentioned to several traders, whenever there's a major economic release or the president's going to speak, or the Fed, whatever, I consider that myself in my own headspace to be the open. So everything prior to that, we can expect maybe nail and bail trades or anything like that. But theoretically, if there's going to be a high impact announcement, that we can regard that as the open, an explosive open that can show up later than normal. So that was 10 a.m. So that can delay things in terms of timings. Now, one of the things I want traders to think about also is that we're on day 2 on the backside of the week. We had markets that formed a large box. That's not unusual on an FOMC week. Monday, Tuesday, Wednesday, forming a box for potential backside opportunities. Now, this is a 5-minute chart. And the other thing I want to just mention again to traders is that once you have your levels and your thesis in place, going down to a smaller time frame can allow you to finesse a better entry once you understand the opportunity that is setting up for you in your session. So we had a market that's dumped down. President Trump was speaking. Our normal 10 a.m. club is now potentially delayed because we have the president speaking. But we have a dump and pump possibly setting up. So our first explosive move right at 10 a.m. clears out the lower level shorts. And then President Trump speaking, we dump back down into our low of day level. Now, if we just go back out to a 15-minute chart for a second, I want traders to think about this. We have a market that's reversed off of FOMC and pushed higher pre-market and dumping back down into the open. It's dumping back down now into potentially higher time frame buyers that have stepped into the market after the FOMC released. We're dumping down into buying areas, higher time frame buying. Now, obviously, on the indexes, we can have large explosive moves even on a 5-minute candle, which is why I repeat again, once you have your thesis in place, using the higher time frame charts, but looking at your levels and then being able to enter in on the smaller time frame. We have a 1-minute chart and we have our levels in place. And now, how does price behave? And are we working the high or are we working the low? Well, obviously, we're working the low of day level in the U.S. session. U.S.-based index, we can use our basic model for trade entry criteria even on our 1-minute chart. And the same thesis applies. Entry, stop loss, and a take profit level. Have our levels in place. The market's dumped down with President Trump speaking. We have our engulfments for a 1-bar stop, coiling back inside of our universal basic model for trade entry criteria. Now, in this particular case, we had higher time frame levels to our left, and that was the high of the week made on Monday as a potential area for this trade to fail. Once this market breaks out of the high of week level, we now have a market that could potentially fail once it's outside. We can project a 200% expansion of the range, and anything outside of this area, traders may be inclined to trail this up to lock in the maximum amount on a winning trade in case it reverses. And you'll notice that that market came right back pretty much to where the New York session opened, closing at almost the same level. But an excellent dump and pump template for traders in the U.S. session, a New York-based index, and reinforcing to keep things simple, regardless of the trade that you're taking, entry, stop loss, and the take profit level. There are only 2 types of templates on any given day, a pump and dump or a dump and pump template. These were just 3 basic opportunities that showed up this week in Asia, London, and New York, and reminding traders that 2 or 3 scalable opportunities a week are enough to significantly compound your trading account. Staying out of messy markets, sticking to simple rinse and repeat templates, entry, stop loss, take profit level, locking in the money, and walking away. It's important to keep things as simple as possible so that you can reproduce your results, not getting caught into messy or choppy markets, 50-50 conditions. Stick with 90-10 opportunities and keep things simple and repeatable. Have a great day, traders, and may the markets go with you.